So imagine a country steps into what is supposed to be this golden era.
Right, like a totally unprecedented era.
Exactly. They join this rich country club, Europe is integrating, the euro is born, and they are just handed an absolute ocean of free, low-interest money.
Just unlimited capital.
Yeah, and there's no war going on, there's no hyperinflation. You would think, I mean, any normal person would think this is the start of an economic miracle, right?
Absolutely, that is the standard assumption.
But, and this is the hook for today's deep dive, over the next decade, this exact country quietly slides into an economic abyss that is actually deeper and worse than the United States during the Great Depression.
It's genuinely one of the most terrifying paradoxes in modern history.
It really is. So, welcome to the deep dive. Today, we are unpacking this incredible, totally counterintuitive investigation by Columbia University professor Ricardo Reis.
Yeah, it's about the Portuguese slump and crash and how it ties into the whole euro crisis.
Right. And for you listening, I just want to warn you, basically everything you think you know about foreign investment and economic growth and how a country gets rich is about to be totally flipped upside down.
Seriously. Because the data we have here is just going to slap you in the face.
Oh, it really is. Okay, let's unpack this. Because the general vibe, if you talk to people about Portugal in the 2000s, is that they just had a mild growth slowdown.
A mild slowdown.
Yeah.
Yeah, that's what the politicians love to say.
Right. But when you actually look at the numbers, it's not a slowdown, it's a flat line.
It's completely staggering. I mean, get this. Between the year 2000 and 2007, their actual output per person grew by a total of 4.3%.
Total for the whole 7 years?
For the entire 7 years.
Yeah.
That is like a microscopic 0.6% a year.
Wow.
And here's where it gets really crazy. If you take their whole trajectory from 2000 to 2012 and you put it on a chart right next to the U.S. during the Great Depression from 1929 to 1941.
Which is the gold standard for an economic nightmare.
Exactly. And you put it next to Japan's famous lost decade in the 90s.
Yeah.
The Portuguese line is worse. It is literally a flat dead line. At the end of that period, Portuguese citizens were actually poorer, relatively speaking, than Americans were at the end of the Great Depression.
Wait. I really want you listening to pause and think about that. Because the Great Depression had a massive stock market crash.
Right. Total systemic collapse.
Thousands of banks just shutting their doors, 25% unemployment overnight. But Portugal, they didn't have a sudden crash in the year 2000.
Nothing. No banking collapse, no war. Just peace.
It's like winning the lottery and then somehow ending up living in your car a year later. How does a country literally drown in an ocean of money?
It was slow motion asphyxiation. And that's exactly why it's so chilling. Because when there's a big violent shock, the government knows exactly what to do. You stimulate the economy. But Portugal's economy just slowly stopped breathing.
Which means everybody panicked and started pointing fingers.
Oh, of course. Human nature. Right. You need a scapegoat.
And the favorite scapegoat of basically any media outlet or politician when the economy stalls is always the workers.
Always the workers. They are greedy, they are lazy, they're asking for too much money.
Right. And the narrative was that Portuguese workers got these massive pay bumps and it made the whole country uncompetitive. And honestly, on the surface, the numbers kind of looked bad, right?
Well, the specific number people pointed to was the cost of labor compared to output. That went up by 20% out to Germany.
Which sounds terrible. 20% more expensive.
It sounds like a smoking gun. But this is the first huge myth we have to bust. Because the data totally proves this is a lie.
A complete myth.
Exactly. When you actually separate the numbers, you see that the real consumption and the actual wages of a normal Portuguese employee barely moved.
Like they weren't suddenly buying luxury cars and taking huge vacations.
Not at all. Their actual consumption grew by just 0.38% a year.
Yeah.
Which is almost exactly the same as the rest of Europe.
So if they weren't getting huge raises, why did the labor costs go up 20%?
Because of the other side of the equation.
Yeah.
Productivity, output. It just totally froze.
Ah, so it wasn't that the workers were being paid more, it's that they were producing way less for the same amount of money.
Right. The workers weren't lazy. They were just trapped in this completely broken system that wouldn't let them work efficiently.
Okay, but what about China? Because 2001 is when China joins the WTO, right?
Right, the famous China shock.
Yeah, and everyone says China just stole all the cheap manufacturing jobs, so couldn't that be why their productivity died?
It's a really logical guess. But again, the data slaps you in the face. It's just not true.
Really? Not even China.
Nope. The researcher looks at the ratio of export prices to import prices. If China was destroying them, Portugal would have had to slash their prices to compete.
Which would make that ratio plummet.
Exactly. But the ratio barely even budged. And look at Spain or Italy.
Right, they exported the same kind of stuff. Textiles, shoes.
Yeah. And they didn't crash anywhere near as hard as Portugal did. So it wasn't greedy workers, and it wasn't China.
Okay, so if it's not the workers and it's not global competition, what on earth was it?
It goes right back to that lottery ticket. The massive, insane flood of foreign cash.
The poison chalice.
Yes. When they adopted the euro, it changed everything overnight.
Because before the euro, if a German bank wanted to lend to Portugal, they had to worry about the currency changing value.
Right, the exchange rate risk. The Portuguese escudo could drop, and the German bank would lose millions. So they charge high interest rates to cover that risk.
But the second they adopt the euro, a euro in Berlin is exactly the same as a euro in Lisbon.
Poof, the risk just evaporates.
Yeah.
And German money just comes flooding south.
Flooding. And we're talking about a terrifying amount of debt here.
Oh, it's wild. By 2007, Portugal owed foreign investors an amount equal to their entire national GDP.
Wait, their net foreign debt was negative 101%.
Yes, they owed the rest of the world an entire year of their whole country's output.
That is just insane. But here's where it gets really weird. Because if you know anything about the euro crisis, you know Spain and Ireland got this same cheap money too.
Right.
But Spain built this massive, crazy housing bubble. Just literal ghost cities.
Empty condos everywhere.
And Greece took all that cheap money and went on this wild government spending spree. But Portugal didn't do that.
No, they didn't. This is the biggest mystery of the whole Eurozone. Portugal didn't have a giant housing bubble. And the government wasn't building crazy vanity projects either.
So if they didn't build ghost cities and they didn't throw wild government parties, where did an entire GDP's worth of cash actually go?
They just lay flat. The money poured into the country, and it totally bypassed all the productive, good parts of the economy.
Okay, we are getting to the absolute core revelation here. And honestly, this totally breaks traditional economics.
It really does. Because we are always taught that foreign investment makes you more efficient.
Right, it's supposed to upgrade your factories and buy you new tech.
But here, the researcher proves what he calls the capital misallocation hypothesis. Foreign capital actually murdered productivity.
It's just so backwards. How does money kill efficiency?
Because of the middleman. All that German cash didn't go straight to businesses. It went to domestic Portuguese banks.
Okay.
And those banks took the money and instead of giving it to highly efficient export companies or tech startups.
The companies that actually compete globally.
Exactly. They completely ignored them.
Yeah.
Instead, they dumped all the cash directly into the lowest efficiency sectors. Local retail, domestic services.
Stuff you can't export.
Right.
But why? If you're a bank with billions of euros, why would you actively choose to give it to the worst businesses?
Because of a concept called a collateral lock. The banking system in Portugal at the time was, let's just say, really backwards.
Their financial brain was just not developed?
Right. They didn't know how to assess real business risk. They didn't care about a company's technology or their future growth. They only cared about one thing: hard collateral.
They just wanted to know if you had a building they could take if you went broke.
Exactly.
Okay, I have to use an analogy here to make this clear for the listener because it's so frustrating. It's basically like a bank refusing to give a loan to a brilliant new tech startup that has a proven product just because they rent their office space.
Yep. No hard assets, no loan.
But then that same bank will happily hand over hundreds of thousands of dollars to a guy opening his fifth totally mediocre coffee shop just because he inherited a piece of commercial real estate from his dad that he can put up as collateral.
That is exactly what happened, but on a massive national scale. The best, most productive export companies had already maxed out their collateral. They hit a ceiling.
So they couldn't borrow a single cent of this new German money?
Not a cent. The banks had all this cash. They had to lend it to someone to make a return, so they just systematically lowered their standards. They just shoved it into any inefficient retail business that happened to own a storefront.
It's just a total mismatch. And the report uses two specific terms for this that I think we need to simplify. It talks about financial integration versus financial deepening.
Right. So financial integration sounds like a great buzzword. Politicians love it. It just means opening your doors to foreign money.
Right. The pipeline gets huge.
Yes. The pipeline opens instantly with the euro. That's the integration. But financial deepening is totally different. Deepening is the actual domestic credit market's ability to be smart, to sort the good businesses from the bad ones.
It's the brain of the operation.
Exactly. So
Yeah.
imagine a scale. Portugal opened its doors to the world at lightning speed, so the money side went way up. But its financial brain, its ability to allocate that money rationally, was totally stuck at the bottom.
So if you have integration without deepening, it's literally an economic death warrant.
It really is. You just get this massive wave of dumb money. And when that dumb money hit the streets of Portugal, it literally mutated the physical landscape of the country.
And the data on this mutation is just wild. Because you assume the booming industries are the most high-tech ones.
Yeah.
But it's a completely terrifying cycle.
It really is. Between 2000 and 2006, manufacturing actually shrank.
Wow.
Even construction shrank.
Which is crazy considering they had so much cheap money, you'd think they'd be building everywhere.
But they weren't. What
Yeah.
grew? Community services, wholesale, retail.
The lowest efficiency stuff.
Exactly.
Mhm.
And this created a massive productivity sinkhole. Across the whole economy, pure efficiency dropped by 1.5% every single year.
They were actively forgetting how to work efficiently.
Yeah, but in the sectors that were sucking up all the new jobs, it was a disaster. Retail efficiency plummeted by nearly 3% a year,
Oh my God.
and real estate collapsed by 4.4% a year. The industries hiring the most people were the ones plunging backward the fastest.
See, this is the part where I just don't get how reality works. Because in a normal capitalist system, if your company is terrible and horribly managed, you go bankrupt. You die.
Right? Creative destruction. The bad companies die so the good ones get the resources.
But in Portugal, the data proves these terrible companies survive for over a decade? How?
Because of zombie firms. The researchers looked at the microdata of individual companies. In a healthy country like Germany, all the businesses operate at roughly the same high level of efficiency. The variance is tiny.
Because if you aren't efficient in Germany, the market kills you.
Exactly. But in Portugal, the variance was massive. There was this huge long tail of absolutely terrible, inefficient companies that just refused to die.
Because the banks kept feeding them.
Yes. The cheap European cash acted as a nutrient bath for bad businesses.
It's literally bad money driving out good money.
Absolutely. The bank kept throwing cheap loans at the zombies, which meant they kept hiring workers, which starved the actual good companies of both talent and capital.
That is just, it's sickening, honestly. But we have to pivot here, because that's the private sector. We have to talk about the government, the hidden fiscal time bomb.
Right, because the government debt exploded too.
And everybody assumes, like we said earlier, that the government debt exploded because corrupt politicians were building massive vanity projects.
Right, the usual suspects, new airports, giant stadiums.
But the data slaps you in the face again. Between 2000 and 2007, public debt shot up by almost 18 percentage points, but actual government purchases fell.
They did. Education spending shrank. Culture spending shrank.
So what on earth were they spending all this borrowed money on?
Literally one single thing, social protection,
Mm-hmm.
and specifically old age pensions.
Pensions, just paying for retirement.
Yes. A full 100% of the spending growth was just pensions.
I mean, that sounds totally, completely boring. And I know we have to stay politically neutral here. We aren't blaming any specific party.
No, not at all. This wasn't some sudden crazy burst of new spending. It was actually a historical ghost coming back to haunt them.
What do you mean by a historical ghost?
Well, back in the early 90s, way before the euro, the government made these incredibly generous pension promises to civil servants.
Oh, to keep everybody happy and aligned with Europe.
Right. But they didn't actually have the money to pay for it then. They just assumed, hey, our economy will be huge in a decade. We'll pay for it with future taxes.
The classic political move. Kick the can down the road.
Exactly. But a decade later, the bill comes due. The workers start retiring. And it happens at the exact moment that the actual economy flatlines because of the zombie firms.
Oh, man. So the engine dies exactly when the biggest invoice arrives.
Precisely. So to pay for these old promises, the government had to literally harvest the future.
Which means they went after the young people. They put a crushing weight on the backs of the young people actually doing the sweating.
Yeah. While the rest of Europe was booming and lowering taxes, Portugal started jacking up taxes right in the middle of a recession.
Which is insane economic policy.
It is. Consumption taxes and labor taxes jumped by 1.7% of their total GDP.
Just to pay for the past. But this ties into something even crueler, right? The labor laws.
The dual labor market. This is the tragic part.
Because older workers, the ones getting these pensions, they had ironclad formal contracts. Under Portuguese law, it was basically impossible to fire them.
Right, near absolute protection. Even if the company was going bankrupt, you couldn't lay off the old expensive guys.
So if a company's desperate, who takes the hit?
They're the youth, the new entrants. Because companies couldn't fire old workers, they just refused to hire young people on permanent contracts.
So they just gave them temp jobs.
Exactly. Over 52% of young workers, ages 15 to 24, were forced onto these highly unstable temporary contracts.
Wow, over half the youth, just completely disposable.
Yes, they became the economy's shock absorbers. You could fire a young temp worker at the end of the month with zero severance.
It's mind-blowing. Laws that were supposedly designed to protect workers literally created a feudal system.
That's exactly what it was.
A privileged class of older workers with permanent jobs and huge pensions, and a massive underclass of disposable youth paying massive taxes to fund it all.
And that extreme tax burden on the youth directly choked off whatever tiny bit of commercial vitality the country had left.
So when the researcher puts all of this into his model, the zombie firms, the bad loans, the heavy taxes, what is the actual final receipt for this disaster?
It's devastating. The model proves that just the capital misallocation alone, just the dumb money going to bad companies, literally evaporated 2.2% of their entire GDP.
2.2% of the wealth, just poof, gone.
Right. And when you add in the tax hikes they needed to pay the pensions, the total wealth lost was nearly 4%.
4% of a nation's wealth just vanished. Not because of a bomb, but because of bad plumbing.
Yeah.
But the craziest part of this whole timeline is that right before the disaster, everybody thought they were rich.
Ah, yes. The false dawn.
So between 1995 and 2000, they were growing at almost 4% a year.
Because interest rates were dropping in anticipation of joining the euro.
So they honestly thought, wow, we are converging with Europe. We are basically becoming Germany.
Right, but they were just getting high on a credit card they hadn't paid the bill for yet.
Oh, that's such a good way to put it. The low interest rate was just an anesthetic.
It was. Everybody was partying, buying things, the government felt rich, but absolutely nobody stopped to upgrade the fragile, broken engine of the actual economy.
And then the music stops.
Very, very violently.
Because in a world of free-flowing global money, the only thing faster than cash flooding in is how fast it escapes. Let's talk about 2010.
So 2010 arrives. The U.S. housing market has already crashed, but then Greece catches fire.
Right, the Greek sovereign debt crisis.
Exactly. Panic spreads instantly across southern Europe. Global investors finally wake up, look at Portugal, see a decade of zero growth and massive debt, and they absolutely panic.
And when bond markets panic, it happens in days.
Months, days, yeah. Their 10-year bond yields. The interest rate the government has to pay to borrow money explodes from under 4% to over 12%.
12%. A government can't function at 12% interest.
No, they can't. And this triggers what economists call the diabolic loop.
The diabolic loop. Okay, explain this, because this sounds like the death blow.
It is. So all those domestic Portuguese banks, they hold massive amounts of Portuguese government debt. They thought it was perfectly safe.
But when the interest rate spikes to 12%, the value of those old bonds crashes.
Exactly. The bank's balance sheets are suddenly filled with toxic trash. They are suddenly facing bankruptcy.
So normally the government has to step in and bail out the banks to stop a total financial collapse.
Right. But the government is already broke. That's why the rates spike in the first place.
Oh my God.
So the government tries to borrow even more money to save the banks, which terrifies the investors even more, which drives the rates even higher, which bankrupts the banks even faster.
They are literally dragging each other off a cliff.
It is a total death spiral. And it all culminated in mid-2011 with something called the sudden stop.
The sudden stop. Just the name alone is scary. What happens?
Private capital completely, 100% evaporates overnight. The money didn't just slow down, it reversed. Foreigners just yanked their money out.
So what does that look like on the ground?
Total devastation. GDP dropped by over 10% in just 2 years. Unemployment skyrocketed to nearly 18%.
18%.
If the European Union and the IMF hadn't stepped in with a massive emergency bailout, Portugal would have literally ceased to function overnight. The ATMs would have gone blank.
But wait, I have a question here. Because when other countries have huge crashes like Argentina or South Korea in the 90s, they go through hell, but they usually bounce back in a couple of years.
Right, the Phoenix miracle. They rise from the ashes.
Yeah. Why didn't Portugal get a Phoenix miracle? Why did they suffer for so many years?
Because of the euro. The euro acted as an unbreakable chain.
How so?
Well, normally when a country crashes, their currency crashes too.
Right, like the peso or the one drops in value against the dollar.
Exactly. Which is painful for buying imports, but it's magic for exports. Because suddenly your factories and your workers look incredibly cheap to the rest of the world.
Oh, so foreign buyers rush in because everything is on sale and you literally export your way out of the crisis.
Bingo. The currency devaluation is an automatic reset button. But Portugal couldn't do that.
Because they don't have the escudo anymore, they have the euro.
Right. They share a currency with Germany. They have no control over it, so they can't devalue their money.
So if you can't lower the value of your money, how do you make things cheap again to compete?
You are forced into internal devaluation.
That sounds ominous.
It's the slowest, most agonizing way to fix an economy. If you can't devalue the currency, you literally have to squeeze the cost of living out of your own citizens.
Oh my God.
You force mass unemployment. You slash government spending. You let people suffer until their wages and rents drop so low that things become cheap enough again.
That is just, it's brutal. It's so easy for us to sit here and talk about charts and data, but you really have to feel for the people living through this.
Yeah, it wasn't just numbers.
This was a lost generation. You have all these young people, 20-somethings, who did everything right, and they step into a world with 18% unemployment, temporary jump contracts, and a government squeezing every penny out of them to pay off old debts.
Hundreds of thousands of them just had to pack up and leave. To London or Angola, just to find work.
It's an absolute tragedy, but it's also a massive warning sign.
It is. Because the big takeaway here is that when an economy just blindly plugs into the fire hose of global money, without first building the smart internal plumbing to put that money into efficient, innovative places.
Without the financial brain.
Right. Tragedy isn't just possible, it's inevitable.
And for you listening, I really want you to think about how this connects to our world today. Because history never repeats perfectly, but it definitely rhymes.
It really does. Look at the world right now.
Trillions of dollars are just blindly sloshing around the globe, right? Everybody is desperately looking for a place to put their money.
Artificial intelligence, green energy transitions, emerging markets.
Exactly. So the big question is, are we doing it again? Are we pumping cheap, euphoric capital into these massively hyped AI sectors without the actual financial plumbing to support real productivity?
Are we just funding a whole new generation of high-tech zombie firms?
Because the venture capital firms just need a place to dump their money. Are we literally setting up the next lost decade right now?
It's a very real possibility.
It's something to really mull over. The next time you hear a politician or a tech CEO bragging about how many billions in foreign investment they just secured, just remember this story.
Yeah, sometimes $1 billion is a blessing.
And sometimes it's a beautifully wrapped, incredibly heavy anchor.
Perfectly said.
Thank you so much for taking this deep dive into the source material with us today. Keep questioning the narrative, and we'll catch you next time.